Expert financial information, none of the awkward. Just Ask is Best Eggs video series where we ask experts the most important questions you want to know or might be afraid to just ask. It's my pleasure to introduce to you our host, Sabrina DeVito.
Welcome to episode 4 of Best Eggs video series called Just Ask. I am delighted to have Matt Schultz, Chief Credit Analyst from LendingTree on today as our guest, where we are going to speak about credit scores and specifically some steps you can take to repair and improve your credit score. Hey, Matt, thanks so much for joining us this morning.
Thanks for having me. Happy to be here.
I'm so glad to have you. Let's go ahead and get started by having you just tell our listeners a little bit about yourself and how did you come to be the Chief Credit Analyst at LendingTree?
Well, I've been at LendingTree for about 2 years now in this role, and I've had a little bit of a winding road career-wise. I started off as a journalist. I ran a website at a newspaper, a local TV station. I even ran a college sports website over the years, but for about the past 10 years, I've worked in personal finance, primarily with a emphasis on credit cards, debit cards, and credit. And I really feel like I sort of found my niche in this space because in a lot of ways, I approach it the same way anybody who is dealing with credit card debt or who has dealt with credit card debt in the past would, because I'm somebody who, when I was 23 or 24, had $10,000 in credit card debt, primarily from making one bad decision after another. And I worked my way through that, had a few rough years where I had all that credit card debt and a new car payment, which was another mistake I made. But you go through that, and sometimes you have to learn some things the hard way. But after that, I started to use credit cards to make them work for me. And I've used points and miles to fly all over the world. And now what I really like about my job is that, especially in times like we're in right now, I feel like it can really have an impact on people because this stuff is really important and can really have an impact on people's lives.
So interesting. And it is so true. We have definitely started to hear from our customers, given that there is a lot of disruption to their finances right now, that they are very concerned about their credit score and what they need to do to protect their credit score. Let's start though with just talking a little bit about the basics. So like, what is a credit score and how does it get calculated?
A credit score is basically a numerical grade on how good you are at paying your bills regularly every month. And from the bank's perspective, they look at it as how risky you are to be lent to. So in a lot of ways, I mean, you can sort of think of it as a parent lending the keys to the car to their kid, where if you have one kid who has had accidents, always misses curfew, and never fills the car up, you're probably not going to be super excited about lending that kid the car keys. But if you have another one who always returns the car full of gas, is always on time, and has never had an accident and has done that for years, you're going to trust them. And it's really very similar with lending. It's all about trust, and your credit score is really kind of like a numerical grade that encompasses a bunch of data points that are on your credit report, which basically indicate how good you are at paying your bills on time. And really what it comes down to is that a lot of people overthink credit. They think that it's this incredibly complex impossible to understand beast. And it is complicated in some ways. There are a lot of tips and tricks, but at a basic level, good credit comes down to three things. It's about paying your bills on time every time, keeping your balances as low as possible, and not going too crazy applying for too much credit too often. And if you do those three things, lather, rinse, repeat, over the course of many years, your credit's going to be just fine. There are definitely things that you can do in between that can help you tweak your score here and there, but ultimately it gets down to those three things, and remembering that this is a marathon rather than a sprint.
Interesting. So in your experience, what do you observe then as being some of the biggest pitfalls that you see that people do that actually damage their credit? And tell us also, like, what are some things they can do to try to avoid those pitfalls?
Yeah, really the biggest issue is just missing payments.
Okay.
Because we've all got to-do lists that are 100 miles long. We're all super busy, and the last thing most of us want to think about is paying bills. But there's nothing more important to your credit score in whatever formula you're looking at than your payment history and how often you pay on time. But the good news is that technology is such now that you shouldn't ever have to be late with a payment. All you have to do is set up auto pay, whether it's through your credit card or through your bank. Set to pay at least the minimum on that card, and that way you'll know that even if you can't pay that statement balance in full each month, you'll know that you're at least making that payment on time, so you won't have that damage done to your credit score, because that's a really significant thing. And even something like a late payment can do 60, 70 plus points damage to your credit score. People don't necessarily understand how significant just a missed payment can be.
Wow.
So that's a really important thing. And another thing that people would be surprised about, I think, is that there are lots and lots of mistakes on people's credit reports. Things that you or I may have not done, but that may appear as something that we did wrong on our credit report. And good credit is tough enough to have without something artificially holding your score down. So it's really important, even if it's just once or a few times a year, to take a look at your credit report, go through it, make sure that all your information is on there correct, make sure that nothing on that report shows a mistake that you didn't make, like if a card issuer says that you paid late once, but you actually didn't. All of those sorts of things can happen because it's human error, it's data entry. The people make mistakes with that. But it's really important that people understand that they need to take a look at their credit reports regularly, ideally through a site like annualcreditreport.com,
Okay.
which is sort of the government mandated, no strings attached, free credit report website for everybody. Or also through my company, we have a service called LendingTree that gives you regular access to your TransUnion credit report and your VantageScore credit score, so you can keep track of that sort of thing.
Those are really good tips, and we'll definitely provide the listeners with links out to both of those. Okay, so biggest thing you see as a pitfall, generally speaking, is just sloppy payments, missed payments. And I love the tip of just setting up the auto pay to just make sure that the minimum hits on time, because even if you want to make a payment on top of that, you certainly can do that, but it just prevents you from ever missing a payment, which is great.
Yeah, absolutely. And it doesn't absolve you from checking once a month to make sure that it actually gets made, because technology is imperfect, as we all know. So sometimes goofy stuff will happen. So it's still incumbent upon you to make sure that the work is being done properly by the technology. And if it isn't, then just give your lender a call and say, hey, I had auto pay set up, but something went weird this month. Something happened. Would you please waive that late payment fee that you assessed me? And there's a pretty good chance that they'll do that.
Hey, Matt, just for the purposes of our listeners, do you know, what's the range of credit scores and what's kind of considered, good, bad, excellent? Just give them a sense of when they're looking at their score, if this is the first time they really start looking at it, how does that work?
Sure. Generally, the range of credit scores is from 300 to 850. 850 being perfect, which very few people attain, and which frankly, you don't even really need to attain. Essentially, if you're looking for the best rates on a mortgage, a personal loan, a credit card, a car loan, if your credit score is 750 or higher, basically anything above that is gravy. There are some people who love to push that credit score higher and higher as a bit of an ego thing or something that they can tell their friends about. But once you get past about 750, you're in really good shape. So then about 700 to about 720 is considered really good. When you get down into the 600s, you're kind of getting into that next tier of credit scoring levels where you're not going to get the best interest rate on a card or a mortgage or something like that, but you'll still likely get accepted. When you get further down below that, certainly in the 500s and lower, it's going to be tough for you to get a really good credit card, and you'll end up often having to pay higher interest rates and that sort of thing. So it's important that people understand that there is very little that is more expensive than having crummy credit. So whatever you can do to bring that 650 credit score up to 720, you should do, or certainly that 580 credit score up to 650, the better off you'll be.
Okay, so let's dig in there. What are some of the steps that people can actually take to begin to see improvement in their credit score?
Again, going back to talking about errors on your credit report, that's often the biggest quick fix that somebody can make. If there's a significant error on that credit report and you can get it fixed, you can really see your credit score jump in a pretty good hurry. And that's obviously ideal, but a lot of folks just won't have that as the case. The other ideal thing would simply be to pay down the balances on what you owe. Life is expensive in 2020, even before the pandemic hit. For a lot of people, that's just not possible. That's just not reality. As much as we should always aim to pay down balances as much as we can, again, life is expensive, but really that is the ideal way to boost your credit score. But the good news is that if you're still battling to knock those balances down, there is another way for you to impact your credit score kind of on the other side of the equation, and that would be by increasing the credit limit on your credit card. is the second most important aspect of any credit scoring formula is what's called your utilization rate. So basically how much debt you have compared to how much available credit you have. So if you have $10,000 in available credit and $3,000 of debt, your utilization rate is 30%, which is about where the conventional wisdom says that you should aim to go no higher than. That's kind of the maximum you want to go. But if you then have your credit limit reduced to 5,000, for example, but your debt is still at 3,000, then your utilization rate goes up to 60%, which is really high and which will do some pretty decent damage to your credit score. And we're seeing people during the pandemic who are having that happen to them, where they're having their credit cards closed or their credit limits slashed without them asking for it, simply because banks are kind of retreating into their shell and eliminating a lot of available credit that isn't being used by folks. But the flip side of that would be that if you have that $3,000 in credit card debt and $10,000 in available credit, and you can bump that available credit number up to 20,000 or even 15,000, that changes the ratio again, and it lowers that utilization rate and can help you bump up your credit score. Obviously, the important thing for people to understand with that is that you can't just view that extra available credit as a reason to go shopping,
Right.
because otherwise you've just defeated the entire purpose of the thing. But if you can handle it properly and you can see it just as a buffer and a way to help your credit score without going crazy spending, it can be a really important tool in bumping up your credit.
And do you have a sense of whether it is better to try to request more credit on existing cards versus opening new cards to increase that credit? Does it matter whether it's new or existing?
In the short term, it does matter if it's new or existing, because when you get a new credit card, you get a short, small ding to your credit because you got that new credit, and that's sometimes seen as a potential sign of desperation. Generally not. Generally the impact of that new credit card is so small and so temporary that the good you gain in your credit by getting that new credit outweighs any short-term damage there would be. But so in the short term, your best move really is to ask one of your current credit card issuers for a bump. The unfortunate thing is that today it's going to be harder to get that credit card increase than it was in January or February, just because banks are tightening things up in the wake of the pandemic. Once we emerge from this, once things reset to normal, they're going to be willing to give again, and it's going to once again be fairly easy for somebody with good credit to ask for a credit card limit bump and get it. But for now, we're just in this really weird space where you may have a tougher time than you might have otherwise.
So I think you bring up an important point. I'm not sure the average person totally understands how, banks sort of make these decisions. But I think if I were to just simplify what you were saying, it is, essentially when the economy is good and everyone seems to be flourishing, they feel more optimistic about people's ability to repay, and therefore if you're proactive and asking for more credit during those times, you are more likely to get it. With unemployment rates topping, 20 million people, banks become concerned about people's ability to be able to repay because there's a lot of financial disruption going on right now. And therefore, they tend to be more conservative about offering line increases. Is that a fair assessment?
That's 1,000% correct. And ultimately what it comes down to is managing risk. And the weird thing about right now is that somebody who in January or February was a very low risk borrower could suddenly overnight become a very risky borrower. And whether it's through a medical emergency, a job loss, or whatever the case might be. And because credit reports and that sort of data comes about fairly slowly, banks don't really have any way of knowing firmly who is risky and who is not. So when they don't have a feel for who's risky and who isn't, they just turn the faucets off and stop lending to most anybody. Not everybody, but certainly an awful lot of people find themselves without the ability to get credit. And we've done studies at LendingTree that have shown that in April and May, the number of new credit cards that were opened in the US was down 65-75% from previous years during that period. And most of that is being driven by the banks kind of retreating into their shells and choosing to wait out this super risky, super volatile, super unpredictable period we're in.
Interesting. Thanks so much for bringing that up. Again, I'm not sure that the average person kind of understands the mechanics behind the thinking there, but I think that's a good tip in the sense of being able to help people be proactive in managing what their credit picture looks like.
Yeah, I think I mentioned this a little earlier, but we have seen a rash of people having their credit limits slashed, having their credit card accounts closed. And most of the time when this happens, it is banks closing down cards or reducing accounts that aren't used very often. Because in good economic times, that available credit is no big deal because they're confident that the borrower will be able to pay it back. But when you hit tough economic times, especially when things turn on a dime like they just have, all of that extra risk becomes, well, all of that extra credit becomes extra risk to banks. So one of the best things that somebody can do if they have credit cards that they haven't used in a while, but they want to keep around, is put some payments on that card. One good way to do it is to shift a small recurring payment like a Netflix subscription or a Spotify subscription to that card on an ongoing basis. And just that $15, $20 a month going through that card regularly will keep it active and could be enough to keep banks from closing it down, because banks, when a card isn't used, they don't make any money off of it. And those are the types of cards that they're most likely to close.
Interesting. And you can put that on auto pay. So it's just like on autopilot for you. So you don't even have to really think about managing the payments on that. Let me switch gears just slightly. I know that when people damage their credit, there are lots of resources and services that you find on, the internet that claim to help people repair and improve their credit. I'd love to know, do you have a handle on what are those resources? What should we be thinking about related to those resources, the good, the bad, and the ugly?
Yeah, there are a lot of resources out there. And if you listen to the radio or you look online, you're going to get bombarded by promises that often sound too good to be true, and oftentimes they are. Um, the truth is that there are plenty of people out there who can help you if you need help repairing your credit. The best ones that are most likely to be legitimate, the most likely to not take your money unnecessarily, um, would be a nonprofit credit counselor, one that would be accredited by a group like the National Foundation for Credit Counseling, and there are other groups as well. These are agencies that work with you and work with your creditors to come up with plans that can help you tackle your debt, or that can even help you do simpler things like making a budget, or just kind of figuring out your next plan to improve your credit. They can also help you with things like bankruptcy and bigger deals like that. But if you're just talking about managing debt, setting a budget, improving your credit, these nonprofit credit counselors can be really useful. And there are important things that you need to know. You need to make sure that you have your agreement with them in writing. You need to make sure that you're comfortable with how they make their money, so you're not going to feel like they are offering things to you just to sell you and make money off of you. But those types of credit counselors, again, from an agency like the National Foundation for Credit Counseling, can be a really good way to help you tackle your credit. There are plenty of things that you can do on your own. I tend to err on the side of telling people that with a few phone calls and a bit of persistence, you can accomplish yourself a lot of what these types of credit repair agencies promise. But I also know that it can be really helpful for folks and really give them peace of mind to have somebody that they trust working on their behalf. So you just need to make sure that you're comfortable and you pick the right person.
Are there agencies out there that, in your opinion, actually care less about preserving your credit score? In other words, might help you pay off debt, but as a result of how they work through this, your credit score really gets even damaged further. I'm not as familiar with who kind of does what, but is that something to look out for, or most of them are working in your best interest on your credit score?
Yeah, I mean, there are definitely things that can be done that will not impact your credit or will impact it less than other things. For example, a debt management plan that you would set up with a nonprofit credit counselor is something that should not impact your credit. It's basically an agreement with you and the credit counselor and and your creditors, and you basically make payments through the credit counseling agency, who then disperses it to your creditors. And payments are still getting made. It's not hurting your credit, but what that sort of thing does is it can help you get lower rates, and it can help you work on some of those terms and fees and other costs that really can make it hard for you to knock down that debt and to improve your credit. What you may run into that can damage your credit would be debt settlement, where if you owe $20,000 in credit, and you work with somebody who says that, okay, we'll make it to where you only have to pay $10,000 of that debt. It sounds great, And obviously nobody wants to, if you can save $10,000 in debt, why wouldn't you do it? But the why is that it will destroy your credit, because so much of credit is paying your bills in full, on time, every time. And if you can work on a plan that will allow you to pay that debt in full over a long period of time, again, as a marathon rather than a sort of thing, it will serve you far better than working on a deal to reduce the amount that you owe, which will then damage your credit substantially and make it harder for you in the future to get any sort of loan that you would want going forward.
That makes sense to me. And so I'll just put in a few plugs here. First, I want to say to our Best Egg customers that if you run into a financial, disruption in your life where you're unable to make payments, we are a company where you should just simply call us. We have payment flexibility because we know that life happens. And when life happens, sometimes you need payment holiday or you need lower payments and things like that. We are happy to work with you. The other thing on the note that you covered is in episode 2, we did interview Peter Klippa from the NFCC, where he talked a little bit about credit counseling and how it works. So if you're a listener and you're interested, definitely tune into episode 2. So Matt, if you could leave our listeners with just one tip for something that would be helpful to repairing their credit score, what would it be?
Main thing that I would tell people is that they have more for their lender than they realize that they do. And far too few people wield that power, and it can end up hurting their credit. It can end up costing them money. And the truth is that if you are a good customer, even fairly good customer, your lender wants you to stick around because banks generally view you as a lifetime relationship. You may have signed up or you may have met that bank through signing up for a credit card, but that bank wants to eventually upsell you to a mortgage, a car loan, whatever other sort of loan you might need. And banks like having customers for a lifetime because they know who you are. They can judge your risk pretty well. So don't underestimate your ability to negotiate with the banks on things like interest rates and late fees and credit limits, and during time like a pandemic or some other natural disaster, you can also ask them for payment deferrals or temporary help in a bad situation. So whether it's your bank, whether it's your credit bureau, or whatever other organization you're talking to, just understand that, like my dad has said for my entire life, he loves to say this, it never hurts to ask. The worst thing that'll happen is that they'll tell you no. But if they don't tell you no, if they say yes, amazing things can happen. And that's certainly true when you're talking, and that's certainly true when it comes to your money, your credit, and things like that. So just remember that nobody cares as much about your money as you do. And when in doubt, that phone call and be proactive to protect your credit and your money. It'll serve you well in the long run.
Hey, that is great. And the one thing I will just add to that Peter mentioned in his interview was, and ask sooner than later. In other words, after you've missed more payments, your options become less. So if you know you're in trouble, reach out sooner than later to try to work with your creditors to set up a plan. And honestly, it's sort of where the spirit of our video series that we call Just Ask came from. Because too many times people are afraid to just ask the questions, just ask for help. And it's important because in most cases, to your exact point, lenders want to keep you as a customer. They want to work with you. They want to work it out. And so you just have to ask. So Go ahead.
Yeah, no, I mean, to put it in simpler terms, it's the same thing as if you go to a clothing store and you buy a pair of pants, the person at the counter is going to ask you if you want a belt or socks. I mean, it's all about lifetime value, upselling you to other products and building a long-term relationship with you. And once you understand your relationship with the bank in that way, it demystifies things a little bit, and it can make you feel a little more empowered and a little more likely to feel good about negotiating that sort of thing.
Well, that's terrific. So on that note, we will wrap up this edition of Just Ask. And I want to say a wholehearted thank you, Matt, for joining us today and for your good advice and tips.
Thank you very much. This was fun.
Awesome. We will be continuing this series in the coming weeks and bringing you more experts like Matt to answer questions that help you get your finances back on track. If you have a question about an area that you're financially struggling with and would like us to tackle in an upcoming video, let us know by reaching out to us here at Best Egg through our Facebook, Twitter, LinkedIn, or Instagram. Until then, stay safe, be healthy, and have an egg-cellent week.